The Panic of 1792 was one of the earliest financial crises in U.S. history. The crisis ended the business boom that followed the American Revolution. The reason for the crisis was an accumulation of mounting debts following the siege of Yorktown, the final battle of the American Revolutionary War. Other causes followed were post-war deflation and high competition in the manufacturing sector from Britain, as well as a lack of adequate credit and a sound currency and interstate trade. The crisis began primarily due to rampant speculation in government securities, particularly bonds issued to finance the war. The newly established Bank of the United States, created in 1791 under the leadership of Alexander Hamilton, played a crucial role by providing credit and facilitating investments which fostered a speculative bubble. In the spring of 1792, the sudden decline in the prices of government bonds triggered panic among investors. As fears spread, a wave of bank runs ensued. Hamilton's intervention was pivotal in stabilizing the situation. He assured investors and provided liquidity to banks, restoring faith in the financial system. His actions laid the groundwork for more structural financial regulations, establishing a more stable banking environment. The Panic of 1819 was the first major economic crisis in the United States and had far-reaching effects on the early republic. The crisis emerged in the context of a post-war expansion following the War of 1812, between the U.S. and Great Britain. The United States experienced rapid economic growth fueled by land speculation and rising prices for agricultural products. However, this growth was built on shaky foundations, including overextension in credit and rampant speculation. In 1818, falling prices for agricultural goods and a tightening of credit led to widespread panic. The Second Bank of the United States, established in 1816, began calling in loans to stabilize its finances, which triggered a wave of bankruptcies and foreclosures. The bank survived an initial round of financial warfare and went on to become even more successful than the first BUS. In the aftermath of the War of 1812, the first truly protective tariff, the Tariff of 1816, was passed. This inaugurated a tendency for further protectionism that lasted until 1833, in the midst of the Jackson years. 1816 thus emerged as a watershed year, with a second BUS and a protective tariff levy going through in the same year. The 20 years after 1816 were accordingly ones of unprecedented growth. John Quincy Adams and Henry Clay were defeated in the 1826 presidential election by Andrew Jackson, the general whom Adams had previously kept out of the White House. Jackson's victory was aided by the rising tide of frontiersmen, poor farmers, and a class of New York radical Jacobins known as the Locofoco movement, who were drawn to Jackson's populist appeal and support for expanded voting rights and democratic reforms coming out of the western states. In the 8 years of Jackson's presidency and the 4 of Van Buren that followed, the entire Hamiltonian economic program was dismantled by a political backlash. The Bank of the United States was eliminated, the protective tariff was reduced, and the internal improvements policy was halted. These changes had far-reaching consequences that lasted until the outbreak of the Civil War, a conflict which Jackson's policies alone did not cause, but likely exacerbated. Jackson personally affected to believe that the banks were evil and should be outlawed. He shared this view with the president of the BUS, Nicholas Biddle of Philadelphia, to whom he said, "I do not dislike your bank more than all banks, but ever since I read the history of the South Sea Bubble, I have been afraid of all banks." Jackson's western base of land speculators and wildcat bankers had good reason to resent the BUS, which was always calling on the state-chartered banks to provide gold and silver coin, or specie, to make good their banknotes received by the federal government for taxes. This tended to restrain land speculation and real estate swindles. The termination of the BUS was the prelude to the most colossal financial crisis of the US economy in the first half of the 19th century. A crisis of the worldwide pound-sterling system, to be sure, but one which the British, in the absence of a US national bank, were able to turn against the US, with tragic and long-lasting consequences. Banks were using their new freedom to issue paper money far in excess of a normal reserve ratio in relation to the gold and silver coin they kept. At the height of the bubble, 2 events converged to produce a panic of tremendous proportions. The Bank of England, seizing as a pretext the fact that the US balance of trade was collapsing, raised its discount rate, which cut off credit by British travelers to American merchants. Those American merchants now needed gold and silver coin to buy from Britain, and had to pull all of their bank deposits to get them. At about this time, Jackson, ever foe to all banks, became alarmed by the Western land bubble, and decided that the federal government must no longer accept paper money from banks for the purchase of Western lands, but only silver and gold coin, or specie. This was the Specie Circular of 1836. Since the state banks in the West had little or no precious metal coins, the land boom was brought to a catastrophic halt, collapsing into panic. There was no hard money left for state banks, and the entire U.S. banking system came crashing down. By May 1837, every bank in the United States had suspended specie payment. Paper money was worthless. The states of Mississippi, Louisiana, Maryland, Pennsylvania, Indiana, and Michigan defaulted on their public debts, undermining U.S. foreign credit for a very long time. There were calls for the federal government to assume the state debts as under Hamilton, but these were ignored by Jackson. The end of the Second Bank of the United States ushered in a period of banking anarchy and monetary disorder. Swarms of state bank issued a debased paper currency, while hard money in the form of gold and silver coin remained scarce. President Van Buren's Independent Treasury Act further exacerbated this situation by severing government ties with the banking system. This policy of non-interference allowed the banks to operate with minimal regulation, leading to recurrent financial crises and economic instability that became a constant feature of economic life in the decades that follow. All of this set the stage for the fatal slide toward the Civil War. The lack of a national bank and the uncertainty around money meant that while there might be some credit fund for railroad building, there would be no credit for the industrial development of the slaveholding South. The mighty wartime boom that began in 1861 continued undiminished until 1873. The financial panic of that year subsumed a joint effort by rival banks on both sides of the Atlantic to eliminate the firm of J. Cook in Philadelphia, the largest bank in the United States. After 1873, the U.S. economy remained depressed for most of the rest of the decade. The Coinage Act of 1873 played a significant role in the economic turmoil of the time by effectively demonetizing silver, which severely impacted North American mining interests. This deflationary environment, coupled with wage cuts, led to widespread labor unrest, exemplified by the Great Railroad Strike of 1877. In 1879, the United States returned to the gold standard through the Specie Payment Resumption Act. This period is recognized by the National Bureau of Economic Research as the longest sustained economic contraction in U.S. history. A severe economic depression under the gold standard began with the Panic of 1893, which was triggered by a rapid decline in the United States' unprotected gold reserves. The Panic of 1893, which occurred at the start of Grover Cleveland's second term as president, and in part a byproduct of a financial crash in Europe. As the National Bureau of Economic Research notes, from 1889, and particularly after the so-called Bearing Panic of 1890 in England, all Europe had recorded subnormal business conditions. Indeed, one reason for the depletion of the American gold reserve was the outflow of foreign capital from investment in America in order to bolster up the waning fortunes of European enterprise. Withdrawal of European investment and a decline in credit availability led to a stock market and banking collapse. This panic was also preceded in part by a run on the gold supply. The Treasury had to issue bonds to purchase enough gold. Profits, investment, and income all fell, leading to political instability, the height of the U.S. populist movement, and the free silver movement. The bank run on deposits of the Knickerbocker Trust Company on October 22, 1907, triggered a severe monetary contraction. The resulting fallout led to Congress establishing the Federal Reserve System. It resulted from the collapse of highly leveraged, speculative investments that were propagating at the time. This led to runs on New York banks and trust companies that had been financing these risky investments. Without a central bank to fall back on, leading financiers, most notably J.P. Morgan, stepped in and put their own money on the line to bail out the surviving Wall Street banks and other financial institutions. This event became the impetus for the establishment of the Aldrich Commission and the Fed. Throughout the 1920s, the U.S. economy expanded rapidly, and the nation's total wealth more than doubled between 1920 and 1929, a period dubbed the Roaring Twenties. On October 24, 1929, as nervous investors began selling overpriced shares en masse, the stock market crash that some had feared happened at last. A record 12.9 million shares were traded that day, known as Black Thursday. 5 days later, on October 29th, or Black Tuesday, some 16 million shares were traded, and another wave of panic swept Wall Street. Millions of shares ended up being worthless, and those investors who had bought stocks on margin with borrowed money were wiped out completely. As consumer confidence vanished in the wake of the stock market crash, the downturn in spending and investment led factories and other businesses to slow down production and begin firing their workers. The Federal Reserve hesitated to address the initial crash and prevent the wave of bank failures that paralyzed the financial system. As Treasury Secretary Andrew Mellon told President Herbert Hoover, liquidate labor, liquidate stocks, liquidate the farmers, liquidate real estate, it'll purge the rottenness out of the system. The crash was exacerbated by the collapse of foreign bonds. Because the demand for American exports had been supported by funds lent to overseas borrowers, this vendor-financed demand for American goods disappeared. At the end of the crash, the market lost $30 billion in value, or approximately $528 billion in today's money. The stock market crash signaled the Great Depression, where 15 million Americans lost jobs, half the country's banks failed by 1933, production and demand fell, sparking breadlines, homelessness across the nation, and farmers were forced to let crops rot, with many starving. By Inauguration Day, May 4, 1933, every U.S. state had ordered all remaining banks to close at the end of the fourth wave of banking panics, and the U.S. Treasury didn't have enough cash to pay all government workers. Nonetheless, FDR projected a calm energy and optimism, famously declaring the only thing we have to fear is fear itself. Roosevelt took immediate action to address the country's banking woes, first announcing a 4-day bank holiday during which all banks would close so that Congress could pass reform legislation and reopen those banks determined to be sound. After showing early signs of recovery beginning in the spring of 1933, the economy continued to improve throughout the next 3 years, during which real GDP, adjusted for inflation, grew at an average rate of 9% per year. A sharp recession hit in 1937, caused in part by the Federal Reserve's decision to increase its requirements for money in reserve. Though the economy began improving again in 1938, the second severe contraction reversed many of the gains in production and employment and prolonged the effects of the Great Depression through the end of the decade. The savings and loan crisis was characterized by the buildup and extended deflation of a real estate lending bubble in the United States from the early 1980s to the early 1990s. This crisis culminated in the collapse of hundreds of savings and loans institutions and the insolvency of the Federal Savings and Loan Insurance Corporation, ultimately costing taxpayers many billions of dollars and contributing to the recession of 1990 to 91. During the Reagan administration, the U.S. merchandise trade deficit grew rapidly, rising from $36 billion in 1982 and reaching $122 billion by 1985. By the mid-1980s, the large and growing trade deficit had become a major concern, with the Reagan administration and others alarmed about the strong dollar and its impact on U.S. competitiveness. The week before the 1987 crash, having come off a very bad week just before, the S&P down more than 9%, sell orders piled upon sell orders as the new week began. From the open on the following Monday, October 19, 1987, the S&P and Dow Jones Industrial Average both shed more than 20% of their value. One automated trading strategy that appears to have been a significant factor in exacerbating the black market crash was portfolio insurance. The strategy is intended to hedge a portfolio of stocks against market risk by short-selling stock index futures. The Dotcom bubble was a rapid rise in U.S. technology stock market valuations, fueled by investments in internet-based companies during the bull market in the late 1990s. The value of equity markets grew exponentially during this period, with the Nasdaq index rising from under 1,000 to more than 5,000 between the years from 1995 to 2000. Things started to change in 2000 and the bubble burst between 2001 and 2002, with equities entering a bear market. Economists have generally underestimated the severity of the recession following the collapse of the stock market bubble in 2001. While the recession was relatively short-lived in terms of lost GDP, it had a profound impact on the labor market, with unemployment levels comparable to the severe recessions of 1973 and 74 and 81 to 82. This underappreciation of the labor market impact has contributed to the understatement of the risks posed by bursting bubbles. The credit crisis resulting from the bursting of the housing bubble is an important cause of the Great Recession in the United States. Increased foreclosure rates in 2006-2007 among U.S. homeowners led to a crisis in August 2008 for subprime markets. There was an unprecedented run-up in home prices. Rents largely rose in step with inflation, which was inconsistent with housing prices being driven by a shortage of housing. Also, the vacancy rate was high and rising through the bubble years. The fact that prices were being driven in part by questionable loans was not a secret. The fact that lenders were issuing loans to people who had not previously been eligible was widely touted by the financial industry. The fact that many of these loans involved little to no down payment was also widely known. The poverty rate in the United States increased from 12.5% in 2007 to more than 15% in 2010. Much wealth was lost as U.S. stock prices, represented by the S&P 500, fell by 57% between 2007 and 2009. Altogether, between late 2007 and early 2009, American households lost an estimated $17 trillion in net worth. 1/4 of households lost at least 75% of their net worth, and more than half lost at least 25%. In a 2018 study, the Federal Reserve Bank of San Francisco found that after the start of the financial crisis, the country's gross domestic product was approximately 7% lower than it would have been had the crisis not occurred, representing a loss of $70,000 in lifetime income for every American. Approximately 7.5 million jobs were lost between 2007 and 2009, representing a doubling of the unemployment rate, which stood at nearly 10% in 2010. For most Americans, recovery from the financial crisis and the Great Depression was exceedingly slow. The pandemic caused the biggest blow to U.S. economy since the Great Depression. GDP fell at a 32.9% annualized rate, the deepest decline since records began back in 1947. 30.2 million Americans were receiving unemployment checks in the week ending July 11th. The sudden shutdown took a drastic toll in the U.S. as businesses shed millions of jobs in an attempt to stay afloat, and 2 presidential administrations had to use executive orders and pass massive spending bills to stave off economic collapse. More than 22 million jobs were lost in just the first 2 months of the crisis, and the unemployment rate rose from a 50-year low of 3.5% in February to a post-war peak of almost 15% in April of 2020. A precipitous decline in aggregate demand pummeled the consumer price level. The resulting disruptions to economic activity significantly tightened financial conditions and impaired the flow of credit to the U.S. households and businesses. The fiscal and monetary policy response in the United States to the crisis was unprecedented in its scale, scope, and speed. Legislation passed by Congress in March 2020, December 2020, and March 2021 provided a total of nearly $5.8 trillion in fiscal support to the U.S. economy, about 28% of U.S. GDP. The sharp contraction and deep uncertainty about the course of the virus and economy sparked a dash for cash, a desire to hold deposits and only the most liquid assets. That disrupted financial markets and threatened to make a dire situation much worse. The Federal Reserve stepped in with a broad array of actions to keep credit flowing to limit the economic damage from the pandemic. These included large purchases of U.S. government and mortgage-backed securities, the Fed in June 2020 purchasing $80 billion a month in treasuries and $40 billion in residential and commercial mortgage-backed securities, and they updated their guidance in December of 2020 to indicate it would slow these purchases once the economy had made substantial further progress towards the Fed goal of maximum employment and price stability. The Fed vastly expanded the scope of its repurchase or repo operations to funnel cash to money markets. The repo market is where firms borrow and lend cash and securities short term, usually overnight. Since disruptions in the repo market can affect the federal funds rate, the Fed's repo operations made cash available to primary dealers in exchange for treasury and other government-backed securities, essentially massively expanding their balance sheet. In mid-March, offshore dollar funding markets came under stress, as manifested by sharp increases in foreign exchange swap basis spreads, which widened to levels last seen in the Great Financial Crisis. If you guys enjoyed the vid, please subscribe to the Buffett Vault, and thank you for watching.